I think we have people joining in here. Welcome, everybody. Is anybody want to give us a thumbs up that audio's working well on your end?
I hear you good, Ray.
Perfect.
Hey, Tom.
How are you?
Good. How you doing?
Good. I prefer when we meet on golf courses.
Much better. Much better. But that's coming. It's 65 and sunny here.
Nice. Yeah, Chicago, we're like, I don't know, mid 40s, but that's okay.
Yeah, I'll just tell you all about it then for today. How's that sound?
It's fine. I got a board meeting in Aruba tomorrow, so.
Well, you can get me back tomorrow. Just holler at me and let me know what it's like.
Yeah, that's twice in 3 weeks I'll be there.
Somebody's got to do it, right?
That's right.
You restarted.
All right.
And
Well, we still have some people coming in, but we'll go ahead and get started 2 minutes after now. Everybody, welcome. Thank you all for joining in. We really appreciate you. We hope this is something that you guys get a lot of value of. We've got a very special guest who's going to be doing most of the talking here and educating, Tom Marros with Alternative Risk Underwriting. They are the captive manager for Great West Captive. And so he's going to do a really great job of educating on the captive, its structure. And we are going to stop throughout just to ask questions. So feel free as we go through this, write your questions down. Feel free to unmute yourself, ask some questions. We really want this to be a great educational event and look forward to it. So thank you guys all again. And Tom, I'll turn it over to you.
All right. Well, thank you very much. Appreciate all of you taking the time. I know insurance is incredibly interesting, especially on a Tuesday afternoon when it's nice outside. So appreciate you guys sticking with us. What we'll do today is I'm sharing my screen now, so hopefully you can see that. We'll just walk through a little bit of an overview of who we are here at Alternative Risk Underwriting, get into captives in general, why member-owned group captives are beneficial to a lot of companies. And then we'll get into some of the specifics on PowerTech Elite, which, as Raymond mentioned, is the captive that we partnered with Great West Casualty for the truck industry. So we'll talk about the specifics on PowerTech Elite, how that works, why that's different from other captives out there in the industry. And as Raymond said, we'll stop and I'll offer the opportunity to ask any questions along the way as we go through this. So feel free to jump in and make it interactive. But really kind of the goal of this is just to explain, one, why captives could be beneficial for you, two, why 30% of the insurance market industry is gravitating towards that. The more sophisticated companies are seeing that. We'll talk a lot about that and why the reasoning behind that is and how the pricing's developed and why it's a lot different than just buying your insurance from the standard market like many of you are today. So as we go through this, again, feel free to jump in and ask questions. As Raymond mentioned, I'm Tom Marros with Alternative Risk Underwriting. What's unique is all we do are member-owned group captives. We're not a retail broker. We don't manage captives and also try to be the broker and the claims management company like some of our competitors out there. We strictly focus on member-owned group captives, so that's what we'll be talking about today. What makes us really unique in the industry is we're the only independent, privately owned captive management company in the U.S. We're probably third largest in the country, but we're the only independent. So we have some that are owned by private equity, which, as you're well aware, I'm sure, private equity has one goal, and that's growth. But when you own a captive and you're doing the underwriting, growth isn't always what you want to focus on. You want to focus on best-in-class companies. So we think those private equity models are broken because of that. And then, of course, you have broker-run captives out there, which, again, is a huge conflict of interest. If Raymond and Michael could price every single account they look at, they'd never miss out on a piece of business. So you don't want your broker setting your premiums because it's a huge conflict of interest. So being private and independently owned, we think is hugely advantageous and beneficial for the shareholders, not only already in the existing captive, but shareholders we're looking at to join the captive. Because we want to make sure that it makes sense for you. We don't want to price you so you think it's a good idea to join and then it doesn't work out. And we'll talk a bit about that as we go through this. So what we do that's unique is we do all that underwriting here in-house. So when we look at your current and 5 prior years of premium, losses, and exposure, we have a whole underwriting team, our own proprietary rating models that are approved by Great West and our other front partners that we use on our various captives. We have actuaries on staff. So we're always looking at your current and 5 prior years of premium, losses, and exposure. That's how we're determining what premiums you should be paying when you join the captive. But what's unique is we do that at each and every renewal as well. And that's what provides a lot of the stability in your pricing when you're in a member-owned group captive, is we're always looking at a 6-year history of premium, losses, and exposure. So even if you have bad years come in, it's muted out by those other 5 years. And that's what provides a lot of that pricing stability year over year. We're dedicated to select agents, so we don't work with just anybody. We're very selective in who we partner with. And that's why we're happy to be here doing this webinar today, even though it's not on a golf course, which we prefer. And then, of course, national and international in scope. All of our captives are based in the Cayman Islands, and I'll talk a little bit about the reasoning behind that. The other part of the international is we have the largest captive in Canada, and that's for Canadian domiciled cross-border trucking fleets that drive into the United States. And I mentioned Cayman. The reason that we picked Cayman is the best venue for member-owned group captives. And what I mean by that is there's even some domiciles now that you can do in the United States. You could have a captive in the US, but people don't really care about captives that much from a legislative standpoint in the United States. It's not that big of an aspect of the insurance industry, whereas in Cayman, it's a huge part of their economy. So they would never pass adverse laws to adversely impact captives in the Cayman Islands. So that's why it's a good venue, because it's nice and stable for member-owned group captives. And that's where we've operated out of since 2001. These are the areas that we focus on a day-to-day basis. It's a pretty busy slide, so I'll go through this rather quickly. And I'm happy to share these slides afterward as well, as long as you keep them for your own personal use. So we're doing all the underwriting, as I mentioned, here in-house. The program design that we have, if you've ever looked at any captive previously, the program structure that ARU has for our member-owned group captives is totally different than any other captive out there in the United States. And it's proprietary to us. I'm going to take you through that here in a little bit. So that program design is unique to us and much less punitive to the individual shareholder. We do all that loss modeling, pricing, and rating in-house, as I mentioned. Develop the new business proposals, which I'll share a sample with you today, kind of give you an idea of if we did have the opportunity to look at you and we were able to price you up, exactly what you'd be seeing from us. And then at each and every renewal, it's the same process. Again, we're always looking at that 6 years of history to determine the price, and that's what provides that stability. We organize the fronting, which today we're going to focus on PowerTech Elite, which is our U.S. trucking captive. That's fronted by Great West Casualty, which I'm sure you guys are aware. AM Best, A+ 15 rated carrier, largest truck writer in North America. They're the ultimate financial security behind the captive and provide the reinsurance capacity for the captive as well. From a claims and loss control standpoint, typically we have a third-party administrator that operates on behalf of the captive shareholders. So it's a little bit of a dynamic shift, because today your claims people are typically operating in the best interest of the insurance company, whereas in a captive, they're operating in the best interest of the shareholders of the captive. So what we've done that's very unique, we wanted to leverage that knowledge, and being that Great West has the best claims adjusters in the country for liability, we wanted to leverage that. So what we've done is they've created a third-party administrator division within their claims team. We have dedicated adjusters that only work on behalf of PowerTech Elite. You get to know those adjusters, build a relationship with them. They report to our claims team here at ARU. So there's a lot more involvement, a lot more input from the shareholders of the captive, from ARU, from Roark Sutton as well. So there's a lot more involvement, a lot more transparency in that claims process, because the better we could do in mitigating those losses and closing them out for the proper reserves and the proper claim settlements, the more profitable the captive is going to be for you within the captive program. So with that, you have online access to all your claims information. We organize 2 semi-annual claim reviews, where if you have open claims, you'd have a time to call in. We'd be on the call. Roark Sutton would be on the call. If it's litigated, the attorney's on the call. The Great West adjusters are on the call. our claims team's on the call, and we roundtable those claims, and we all make sure we know exactly what's going on with that claim and that it's being mitigated in your best interest. So it's just a lot more transparency and involvement, and we make sure to hold their feet to the fire as far as reserve setting and things of that nature as well. And similar with loss control services, we wanted to aggregate the experience of Great West, but we also wanted to leverage, we have about 80 shareholders in the PowerTech Elite Group Captive. We wanted to leverage, these are the best in class companies because we only look at the top 30% of fleets in the country. That's our initial qualifier to be able to get into PowerTech. So with that, we wanted to take the Great West loss control services, but couple them with our own proprietary loss control approach where we're being peer reviewed against how we're all performing. So it doesn't mean anybody's seeing your information, but what it means is we could hold ourselves to higher standards because all of these are the best companies, the top 30 companies in the country. Similar with financial, everything we do is totally transparent. So each shareholder receives their own individual shareholder report. It shows you every single dollar you paid in, exactly what bucket it's sitting in. So what your premiums are, your paid claims, the reserves, what your IBNR, that magical actuarial factor, what's being allocated to you, what investment income you earned, and ultimately it shows you the profit that you've built up through your captive program. And those shareholder reports come directly from the PwC audited financials, which you also get a full copy of the PwC audited financials for the captive. And I mentioned investment consultant or the investment income. That's a huge aspect of insurance. If you think about it today, you pay in your premium pretty quickly over that policy term. And then if you do have claims, those claims are paid out pretty slowly over the next 3 or 4 years, depending on if it's a litigated claim or not. In the meantime, today, the insurance company takes all that premium and they invest it and earn that investment return for themselves. We do the exact same thing, but the big difference is that investment return goes back to the shareholders. So what we've done is we utilize a division of Morgan Stanley called Greystone. Greystone oversees the investments for PowerTech Elite, but also for all of our captives. So we have over $500 million under management with them. So we pay 17 basis points for investment management fees, which means there's a lot of profitability coming back to the shareholders through that investment management. We provide the actuarial oversight and review, day-to-day accounting and invoicing, and then oversight of our general support services from our captive manager in Cayman, which is SRS, Strategic Risk Solutions. They're the largest independent captive manager in the world, the third largest overall. They're our minded management in Cayman. They keep the captive legal. Audits, I mentioned, are compiled by PwC. And then something that, this is a little bit Captive 201, so it's a little bit advanced, but something that's incredibly unique is when you join a member-owned group captive, you actually have to pay tax on the profits that are going to be coming back to you. What's unique is every captive out there in the United States, you have to wait a few years, of course, to get your actual underwriting dividends because this is long-tail business. They have to wait for those claims to close out. So what that means is in that first year, if you're profitable, you have to dig in your own pocket and front the tax liability for the profits that you're going to get down the road. We're the only captives in the United States. We pay you a 40% tax dividend starting in year 1. So if you're in the captive and you're allocated $100,000 of income, you're going to get a wire for $40,000 to cover that tax liability. No other captive even talks about that because they don't want you to know that it's a negative where you have to pay that $40,000 out of your own pocket. That's why we send you that tax dividend to cover that tax liability. I'll stop for the first time. Are there any questions on any of this? I know it's a pretty busy slide. Perfect. I don't even know if you could unmute yourself, so it was just a guess, but we figured we'd try. These are our current captive programs, just to give you a little bit of our history. Obviously, we're going to focus on PowerTech Elite, but just to give you a little of our history, Pillar is our commercial construction captive, founded in 2005. We have about 100 shareholders all across the country in Pillar. That's for commercial construction, so infrastructure, street and road, heavy highway, mechanical contractors. With that, we write around $125 million in premium. Terra is our oldest captive, started in 2001. That's for food and agriculture. So 65% of the produce that ends up in a U.S. grocery store comes from a Terra member. Steadfast is our heterogeneous captive, so that's kind of our kitchen sink. So if you're not U.S. trucking, commercial construction, or food and ag, we'd look at you for Steadfast. PowerTech, which is what we're going to focus on today, that's for true truckmen. So it's U.S. domiciled true trucking fleets. What's unique is we could write the workers' compensation, auto liability, auto physical damage, cargo, and GL. A lot of the captives don't want to write all those lines, but we can incorporate all those lines. We also put up a primary 2 million liability limit. So we always automatically include that 2 million primary liability limit, which we think is going to become incredibly more important as we see some changes. For instance, New Jersey was the first state to go to a minimum requirement of 1.5 million. So we think other states will be following suit. By the fact that we're putting up that 2 million and controlling that all with Great West makes it much more cost effective when you buy that excess limit. Minimum premium, typically $250,000. We can utilize different deductibles. So we have deductibles ranging from $10,000 up to $200,000. And when I get to the structure, I'll explain how that works. Paragon, and sorry, on PowerTech, as I mentioned, we have 80 shareholders and we write around 70 million in premium. Paragon is our property captive. So that's for companies that pay 100,000 or more in property insurance premiums. It's a way to help control the ever increasing property insurance market. And then Pioneer is our health benefits stop loss captive. So we do have a lot of trucking fleets that participate in this. If you have more than 50 enrolled employees on a health benefits plan, this is a way to help control those health benefit costs. And then, as I mentioned at the beginning, Polaris is the largest captive in Canada, so obviously the largest trucking captive, and that's for Canadian domiciled cross-border trucking fleets driving into the U.S., and we started that in 2005. So eligibility, typically what we're looking for PowerTech, as I mentioned, U.S. domiciled true trucking risks. We're not looking for waste haulers or moving companies. We're looking at true truckmen. Minimum premium, $250,000 if we're not including the work comp. Typically, if we're going to include the work comp, it's about $300,000. I say our average member is $800,000, but as you recall, I mentioned we use different deductibles. So really, because of our unique structure and deductibles, fleet size goes from about 20 units up to about 1,200 units. So it could really run the gambit because of our unique structure that I'll walk you through here momentarily. A minimum 5 years in business, a solid financial condition, and then really important are those strong commitments to safety and loss control. And what we mean by that is we want to see that top-down senior management bought into safety culture, because that's going to breed it throughout the whole organization. So we think that's really important if you're going to be joining a captive, to really have that safety focus from a senior management perspective. Willingness to be involved, that's really twofold. One is we have our annual shareholder meeting that's held once a year offshore. That shareholder meeting, it's not an insurance meeting, it's a board of directors meeting. So all the shareholders are invited to attend that board meeting. And we think it's important that you're there with your fellow shareholders, that you own this mutual insurance company together. So we think it's important to attend that board meeting. And then also we have what's called the safety subcommittee, which we get all the 80 people responsible for safety from all the various fleets together once a year in person. We bring in what we're seeing in the industry. So we bring in new emerging technology. We bring in, we look at our loss history and we see what type of losses we're having. We bring in experts to help us identify new ways to combat those losses. We bring in people to talk about what to do when you do have an accident, as far as what information the plaintiff's attorneys are going to want to see and how to best prepare yourself. So it's really a great opportunity to go from having a few people at your organization focused on safety to a room of 80 other best-in-class people that know safety, best-in-class fleets that you could share, talk to, and build a relationship with. So that's really the extent of willingness to be involved. There are more opportunities, but at a minimum, that's kind of what we say is attend that annual shareholder meeting and then send your safety representative to the safety meeting. And then, of course, long-term approach. This is a philosophical change in how you buy insurance. You're going from being a renter of insurance, which is what you're doing today, to being an owner with the other shareholders of your own reinsurance company. So it's really that marriage-minded approach. So what makes PowerTech different from other captive programs out there is, one, the structure. It's incredibly unique and much plus punitive to any individual shareholder. And as I walk you through that, I'll explain that a bit more in detail. It really minimizes that volatility year over year. Again, everything we do is transparent. So it's a member-owned company. So everything is totally transparent. As I mentioned, we only look at the top fleets in the country, the top 30, 35% of fleets in the country. So we really have that quality over quantity approach. For PowerTech, since it started over 5 years ago, we've looked at close to 3,800 fleets over that 5-year period. we decline about 93% of what we look at. The two types of dividends, those tax dividends that start in year one, and then your underwriting dividends, which come out from your profitability and investment income, which are paid to you 4 years after expiration. A seat at the table for you as well as your agent. We think your agents are an important part of your insurance success, so we want them to understand the captive so they can continue to be an advocate for you. Best-in-class service providers. Again, Great West is our fronting company, overseeing the claims in partnership with us, as well as providing the loss control. They're the ultimate financial security behind the captive. The $2 million in primary limits we think is incredibly important. We also automatically include $1 million in a cargo limit for you as well. All the forms are specialized to truck, so nobody would know that you're in a captive unless you told them. Your policy looks like a standard Great West insurance policy. The captive is happening behind the scenes. So we think all those things make PowerTech incredibly unique in the industry. These are the service providers, and I know I mentioned a lot of these names as we've gone through this so far, but what's really important here to understand is they all operate independently of each other. So again, we're the overall program manager. Great West is overseeing the claims, the fronting, and reinsurance. UBS is the credit facility, so Great West loves us and trusts us, but we want to get them to send those premium dollars to Morgan Stanley to be invested on your behalf. So UBS gives them a letter of credit to guarantee those funds. Strategic Risk Solutions, again, they're our on-island captive manager in Cayman. Pinnacle's our outside actuary who confers with our internal actuaries. Scotiabank is the checking account. PwC compiles that audit every year, which again, you get a full copy of, and that's where your individual shareholder statement comes from. And then KPMG is issuing what's called a 5471 form and calculating the tax dividend that's payable to each member each year, starting in year one. So all of these parts operate independently. And what I mean by that is, for instance, if SRS was doing a bad job managing the captive, we could unplug them and plug in a new captive manager, and it doesn't affect the rest of the captive. All the other service providers continue to do what they do. Whereas a lot of captives out there, especially some of these broker-owned captives, they'll own their captive manager. They'll own their claims handling company. So it's really hard to fire yourself. So then you're not getting best-in-class service because you're stuck with the services that they picked. Whereas here, again, being a member-owned group captive and all of these areas operating independently ensures that we'll always have best-in-class service for the shareholders by doing that. There's no conflicts of interest. So really you have three options for your insurance. Traditional insurance, which is what you're doing today, you're transferring all the risk, all the profit to the insurance company. You write a check and you kind of forget about it. They're going to operate in their best interest, which isn't always your best interest. You have self-insurance, but that's really only suitable for incredibly large organizations. They're retaining all the risk, all the losses, way too volatile for mid-sized companies. You're not getting the balance sheet protection that you need through buying insurance. And that's where captives come in. Ours are custom designed for mid-sized companies. All you're doing is taking on a predictable layer of risk. Then we have a shared pool and reinsurance for those larger unpredictable type claims. So ultimately what's left over plus the investment income, that's what's coming back to you. And we think that's the best solution for those well-managed companies. I always put up the definition of what a group captive is, because really there's one key word in that definition. So if you think about it, what's happening is PowerTech Elite is a reinsurance company formed on behalf of a group of like-minded shareholders to take on that predictable layer of risk. And that's the key word there, is a lot of people think in a captive, there's more risk than being in the standard market. That's actually untrue. In a captive, because you're taking on that predictable layer, it's much more stable than the traditional marketplace. And as we go through this, we'll explain that a bit more. But really what's happening behind the scenes is Great West is essentially buying that first layer of coverage from the PowerTech Elite Group captive. So reasons that you contemplate doing this, one, much greater control. Greater control over your claim handling, greater control over your coverages, your deductibles, your pricing. Stability in pricing is a huge reason. Because we're always looking at that 6 years of history, even if a couple bad years come in, it's still going to be muted out by those other years. So you're going to see a great amount of stability year over year in your pricing. You're not going to see the peaks and valleys that you see in the standard market. And with that stability, if you think about it, what happens in the standard market is they're only looking at what you've done for them most recently, and their job is to try to charge you as much as they possibly can without you leaving. That's what they're trying to do. In the captive, as an underwriter, we're wrong 100% of the time. We try to be a little wrong to the conservative side because all that profit and investment income, that's going to come back to you. And then, of course, availability. If you did run into a couple years of bad luck, just some claims that you typically don't have, in the standard market, you may wake up and find that you have a non-renewal notice. And now it's hard to find and replace that insurance coverage. In the captive, as long as you're working with us, even if you run into that streak of bad luck, you'll always have availability of insurance because we're going to help get you back to where you were, because you had to be good for 6 years to get in. So we're going to help nurse you back and make it so you always have that availability of insurance. The dividend potential, of course, as I mentioned, what's not used to pay those frequency claims plus the investment income, that's what's coming back to you. So ultimately, you're paying cost for your insurance. You're paying for the expenses of running the program, which you are paying for today through your regular policy. It's just the insurance company keeps the profit. Here, yes, we still have to pay for the expenses, but that profit comes back to you. Flexibility and coverages, as I mentioned, and then increased leverage. You're part of a $65 million buying group. You have a lot more leverage with the marketplace, and that premium volume helps us control that severity type claims. So there's a lot more stability because of that increased leverage as well. So this slide just visually represents what we're talking about here today. If you paid $800,000 for a guaranteed cost insurance policy, that's represented by that white line. So regardless of what your loss ratio is that you see at the bottom there, your minimum cost for insurance would be $800,000, even at a 0% loss ratio. Your maximum cost, of course, would be $800,000 as well, even at a 100% or plus loss ratio. That blue line represents that same exposure within the captive. So you can see even at a 0% loss ratio, we still have the expenses of reinsurance, front fees, taxes, everything that's built into your policy today. But the difference between that white line and that blue line, that's your profit potential. And there's a great amount of profit potential all the way up to about an 80-85% loss ratio. There is some risk associated with a captive, but it's really important to understand a couple key things. And some of these things are unique to ARU's captive structure and PowerTech Elite. One, there's an aggregate built in. So there's a worst case scenario in a given policy year, which that's pretty similar with most captives. Most captives have that. So there's a worst case scenario. You know exactly what that is going in for that particular policy year. Two, because of our unique structure, one loss cannot put you into this risk area, whereas in other captives, absolutely it can. And then three, we look at you cumulatively for all years. And I'll briefly explain it now, and I'll talk a bit more about it as we go through a pricing sample. But what I mean by that is no other captive in the United States, they only look at you year by year. So every year fully stands on its own. So for instance, you could join a captive, you have 2 really good years. You made $100,000 each year. So you're positive $200,000 after those 2 years. But then in the third year, you have a rough year and you're negative $50,000 that year. Every other captive out there, they will give you what's called an assessment, and you'll have to pay that $50,000 in. We don't have assessments, but we also look at you cumulatively. So if you were positive 200,000 and you go negative 50, well, cumulatively, you're still positive $150,000. Why would we ask you to pay in $50,000 so we could send you a larger dividend check down the road? It doesn't make any sense. So we always look at you cumulatively, so those good years will help offset the bad years. And that's incredibly unique. No other captive does that in the United States. So I'm going to jump into the structure. Again, I'm not sure if you could unmute yourself, but are there any questions before I jump into the structure? Or Raymond, do you have any questions?
Hey, Tom, can I ask you a question to expand on real quick?
Absolutely.
When you mentioned earlier that 93% of the applicants get declinations, can you speak to how that is actually really good for the folks that make it through, and you're not just setting a bar that's almost unattainable, but why is it so stringent trying to get into the captive?
Sure. So 93% is, I guess I should say that a different way. 7% join the captive of what we look at. we decline a incredibly large amount up front. The first thing that we utilize is the Great West Prospect Scoring Tool, which they've built this based on their 80 years of experience. They built an artificial intelligence tool that looks at your public and privately available data to determine where you rank based on their proprietary calculations in the country based on your scores. So we only look at the top 35% of that. Of that 35%, we still might not think it's a good fit from a loss standpoint. We might say, hey, you could have the best score in the country, but maybe your losses just don't add up to what that score should be, because we're doing the math on the underwriting aspect. But the reason you want that is because you want to be sure that you're in a best-in-class group. If you could pick, we can't pick our family, but we can pick who we do business with. So we think it's important to make sure that you're in that best-in-class group. Again, there's a lot of captives out there that they want to grow simply to grow. If we didn't find any good risks this year that were a good fit for PTE, that's okay. We don't have to add any. But every year, of course, because there are a lot of great trucking fleets out there, we do add 10, 15 members every year because we do find those good fleets because we have such a big funnel. And again, this kind of compares to if you were working with a broker-owned captive provider, their funnel is only this big because they could only look at new business for themselves or their existing book of business. With us, we have 3,500 agents feeding us opportunities across the country. So we have a huge funnel. So that gives us the ability to be incredibly picky. And that's beneficial to the whole group.
Yeah, thank you, Tom.
So jumping through the structure here, this is the big picture of the captive. So again, we put up a $2 million in primary liability limits, $1 million in cargo, statutory on work comp if we are looking at the work comp. The captive takes the first 500,000 of any occurrence. And we're going to break that down into a couple different buckets here. So again, you see the 2 million in limits on the left. All we're doing is breaking this up into these various retention buckets. That first bucket you see there is called the dividend pool. The dividend pool pays for the first $200,000 of any occurrence. So across all lines of business, that's how we define an occurrence. So for instance, if you had a rollover that involved cargo and some bodily injury, that's one occurrence. It's not by line of business. It's all combined together. So that dividend pool pays the first $200,000 of any loss. That dividend pool, as far as what we're funding to it, is totally unique to each individual shareholder. So based on your current and 5 prior years of premium, losses, and exposure, I'm going to conservatively actuarially develop a funding number that we're going to fund into that bucket. This is only used to pay your claims. So this is your dividend pool is totally unique to you. So we fund that with some dollars that we actuarially develop, and what's left over plus investment income, that's what's coming back to you. So this is where the majority of your profit comes from. Once an occurrence gets over 200,000, and this is where it gets way different than any other captive. Once an occurrence gets over $200,000, it goes to what's called the risk sharing pool. The risk sharing pool covers a $300,000 layer. So it covers from 200,000 up to 500,000. If you have a loss that's greater than $200,000 and goes into this bucket, it is not counted against you because this is more of a severity type claim. So our risk sharing pool operates like reinsurance. Then, of course, if the loss is over $500,000, it would transfer to Great West, and they would pay for that up to our policy limits of $2 million. So what's happening here that's unique is the losses always go vertical. For anyone who's ever seen an A fund, B fund captive, or a severity frequency fund captive, that's not how they operate. And I'm going to walk through a few claim examples, and I'll point that out here. So for instance, let's assume we funded $300,000 to this member's dividend pool. So this might be, maybe it's a $500,000 account total. And they have a $200,000 claim. Pretty simple. That means they have $100,000 plus investment income. That's what's going to come back to them. But then let's look and see what happens if you had a $500,000 occurrence. 200,000 comes from your dividend pool. So 200,000 comes from your bucket. 300,000 comes from that risk sharing pool, not counted against you. So even with this $500,000 occurrence, you would still be getting back $100,000 plus investment income. And then we look at what happens if we had a $2 million occurrence. Again, same situation. Your maximum exposure from any occurrence is at 200,000 from your dividend pool. So 200,000 comes from your dividend pool. 300,000 comes from that risk sharing pool, not counted against you. And the rest up to policy limits is paid for by the reinsurer. So even with a $2 million occurrence, this particular company would get $100,000 plus investment income coming back to them. In any other captive, they would call this dividend pool an A fund or a frequency fund. And this risk sharing pool, they call it a B fund or a severity fund. And the same loss, what would happen? It would go through the A fund. It would take that retention. So let's just assume it was 200,000. So it takes 200,000. Then it goes up to what they call the B fund. It only takes the money that you paid in. So maybe your premium was 100,000 to that B fund. It would take 100,000. Then it comes back down to your A fund, takes any other money there, and potentially drives you negative before it shares risk. So from that one large claim, you're totally wiped out for the year. We don't think that makes any sense because you could be the best fleet in the world. You could have the best safety technology, the best safety manager, and the best drivers, and that doesn't preclude you from being in a bad county and getting rear-ended by a vehicle with 5 passengers in it and dragged into $1 million claim. You did nothing wrong. There was nothing different you could have done in that situation. Why should that blow you out in the captive for a year? That's why our structure works this way, because if you can control your frequency claims, then it'll be profitable for you. Those frequency claims with good safety and good loss control, you can control. What you can't control are those crazy severity claims that you have limited control over. That's why this structure rewards you for controlling those frequency claims and doesn't penalize you like an A fund, B fund captive for having a severity claim. Normally I'd ask if there's any questions, but I won't here. So it's pretty simple. The structure goes vertical. Now I'm going to walk you through a pricing example because we're going to put some numbers to these buckets now. So sometimes I could draw on the screen. We'll see if it won't allow me today. That's okay. So this was based on, and again, every price is individually developed. Every account, every fleet is individually underwritten. So don't pay too much attention to the numbers. I just more want you to get an understanding of what bucket they're sitting in. So this happened to be based on 70 power units. It looks like we were only looking at auto liability, physical damage, and cargo. We had a $25,000 combined max deductible. So what we mean is that applies one time for any occurrence. It's not by line of business. So based on this company's premium, losses, and exposure, we conservatively determine that we're going to fund $195, $185 to their dividend pool. So that's the money that's going to be sitting in that first bucket to cover their up to $200,000 of any occurrence. Now you might think, well, that's not even $200,000, but that's because historically, based on their 6 years average, this is a good conservative profitable number to be funding into their dividend pool. Because remember, we're looking at you cumulatively for all years. Their risk sharing pool, so essentially buying coverage from 200,000 up to 500,000 would be 83,344, which means their loss pool or captive layer premium is 278,530. So that's the money that's going to be sitting offshore, earning investment income on their behalf. Expenses and reinsurance, which they must have been in a more expensive reinsurance state. But again, this is for the $2 million in primary limits. And the way that we develop the reinsurance pricing is based on your IFTA. So everybody's unique in this manner. 353,230, which gives us a total premium for this particular company of the 631,759. So that's in their first bucket is sitting at 195. Their contribution to the risk sharing pool, which is buying coverage from 200 to 500, is the 83. And that's how we're funding their buckets, if you will. Down below, we have a couple other items that are outside the premium. The first is the claims administration fee. We pay the Great West TPA 1.5% of premium for life of the file handling, no matter how many claims this particular company would have in a given year. Offshore expense, $12,000. Every member, regardless of size, pays the same amounts. This $12,000 goes to SRS in the Cayman Islands. It's used to cover the day-to-day legal and regulatory fees in Cayman. This is a totally auditable fee. It's broken down in your shareholder report. The lion's share of this is used to cover the meeting expenses. So I mentioned it's important to attend that annual shareholder meeting. So the captive pays for your hotel rooms and your dinners. You just have to get yourself to that meeting location. Again, this is a totally auditable fee. broken down in your shareholder report. Whatever's not used just goes to your dividend pool balance. We had an agent broker fee that was built in here on this particular account, which gets us to our total of the $700,617. So your premium alone really isn't enough to capitalize and collateralize owning your own reinsurance company, because that's really what we're talking about here today. So we do have a couple other capital and collateral components that I'll just cover briefly here. The first one is the one-time capital contribution of $30,000. This buys your share of stock in the PowerTech Elite Captive. This $30,000 is an asset on your books. It earns investment income, and you get this back if you ever decided to leave. The other item we have here is what's called dividend pool collateral. So I mentioned there's a worst case scenario in a given year. There's an aggregate built in. So we want to protect member-to-member credit risk, because you wouldn't want to have a member join the captive. They have way more than anticipated frequency claims in their dividend pool, and then they go out of business or they leave. You don't want the rest of the members holding the bag. So all captives get this. We spread ours out over 5 years to make it more cash flow friendly. Most captives get the same number, but they only do it over 3 years. So $97,593. What that is that's 50% of the dividend pool premium. So it's 50% of the $195. That could be cash or letter of credit. If it's cash, it earns interest at the captive interest rate. Both cash and letter of credit are fully returnable upon redemption of your stock. So you get this back if you ever decided to leave as well. So the way we vest it is 50% in the first year, 45% of your dividend pool premium in the second year, and 35% in years 3, 4, and 5. So again, ultimately, as all captives do, we'll get to 2 times their average dividend pool premium. So this company would have about $390,000 posted over 5 years, again, in the form of cash or letter of credit or any combination of it. A lot of the trucking fleets like to utilize cash because they can incorporate it into their premium finance agreement. And then that money's sitting offshore, earning that investment return for them, and they get that back if they ever decided to leave as well. So now we'll go to what I call the good news page. And again, I know a lot of this is a lot of numbers coming pretty quick, but I just kind of want to give you that sample so you know what you'd be getting if we provided you with if we had the opportunity to provide you with an indication. So then we also now have what's called, I call this the good news page, and this correlates directly to the page we just looked at. So what we want to do at the top here is lay out the program boundaries. So we want to look at absolute best case scenario, conservatively predicted, and then worst case scenario in a given year. But that worst case scenario, again, doesn't really matter, because if you recall, I mentioned we look at you cumulatively for all years. So minimum cost is 0 losses. So if this company had 0 losses in their dividend pool, that means the 0 losses plus the expenses of the program would be $422,088. They'd earn about $62,000 in investment income. Because if you remember, I mentioned dividends are paid out 4 years after expiration. So all that money sitting there with Greystone being invested, earning that investment return, using a conservative 5% here, which typically the captive averages between 7 and 9%, but we use a conservative 5%, that'd be $62,669. That makes their final net cost for insurance $359,419. Now they paid in that $700,617. So absolute best case scenario, we don't expect it. We just want to show them this boundary, would be a return of $341,000. The next line, captive premium, is saying we hit the nail on the head. And they performed exactly as we conservatively indicated. If you recall, we funded their dividend pool with 195, 185. We're saying that's exactly what they had in losses that year. If that happened, $700,617 would be their incurred loss and expenses. They'd only earn $25,000 because we're paying those losses out over the course of that time frame, giving them a final net cost of $674,709. They paid in the $700,000. So basically what they're getting back is their investment income, $25,000. Now the next line, maximum cost, and I'm going to talk about this a little bit here for a moment. Again, maximum cost only matters if it's very early on when you join the captive, because remember, we're looking at you cumulatively. So I'm looking at this $919,000 number down here, but let's talk about what would happen in case this ever did happen. Maximum cost, $390,000 of losses. That's where they hit their aggregate. But think about that unique structure. how the losses are always going vertical. So think about how hard this would be. Knock on wood, it doesn't happen. Day one, they had $1 million claim. That takes $200,000 out of their bucket. 5 months into the policy, they have a $500,000 claim. That would go to that bucket. That would only take $190,000 out. They've hit their aggregate cap between those two claims now. Any other claim that comes in would bypass their dividend pool, go to that risk sharing pool and the reinsurers because they're capped out for the year. Whereas in any other captive with an A fund, B fund structure, this would result from the first $1 million claim. Whereas with us, it would take multiple occurrences because it's capped at 200,000. If that happened in the first year, their incurred loss and expense would now be 895,000. They only earn 12,000 in investment income because we're paying those claims out pretty quickly, giving them a final net cost of 882. They paid in that 700,000 again. You look over here and you go, uh-oh, they're upside down by 182,000. Again, it doesn't matter unless cumulatively that's where they're at. So if they had joined the year before and made 200,000, that means cumulatively, they're only upside down by $17,643. If that was the case, they don't owe a penny. But let's just say this was the first year. They still don't owe $82,000. Every other captive, they would owe that $182,000. But with us, what we're going to do is we're going to give you 3 years to work yourself out of that. Because remember, you had to be good for 6 years to get in. So if you were negative 182, we are going to ask you for 1/3 of your negative balance, what we call negative dividend pool cash collateral, because you increase that credit risk for the other members. So you're going to post about $56,000. We go into that first year, you being negative. Let's assume it was like their 2018 year down here, and they had 14,000 in loss. If you walk through that, that would have returned 231,000 in profit. Well, cumulatively then, they're almost positive $50,000. We give them back that additional collateral they posted and waive any future. So as long as you can get back to positive in 3 years, we give you back any of that additional collateral you had to post. And the reason that's hugely important is any other captive, when you're getting an assessment, you can't even deduct that as premium. That comes right out of your retained earnings because that's a capital assessment. That's why we do it this way, because our captives are really designed to, one, protect you from that severity type loss where you're controlling your frequency, it's going to be profitable. And then 2, protect you from cash flow risk because we're looking at you cumulatively for all years. So again, this would only matter if it was very early on in your experience. And then what we do is we do a 5-year look back for you. So we take your actual loss history, and we're able to do this. No other captive can do this because they have that A fund, B fund, and they're sharing losses, and people are using your money for different things. With us, that doesn't happen because your dividend pool is your dividend pool, and any loss above that does not impact your equity. So we can give you an actual 5-year look back. So you can see this company, as I mentioned, 2018, they had 14,000 in loss. That means their incurred loss and expense would have been 519. They would have earned about 50,000 in investment income, giving them a final net cost of 469. They paid in the 700,000, so they would have got back 231,000 that year. The next year, and I won't go through it individually, but 54,000 in loss would have generated a return of 184. 2020, 55,000 in loss would have returned 183. 2021, 36,000 in loss would have generated a return of 205, and 117 in the 22 year would have generated a return of 114. So if this company performs exactly as they have for the last 5 years, the next 5 years, they'll have an extra 919,000. So I can tell this company did join the captive.
Tom, I was just going to bring up if anyone, anyone's sitting here and maybe their head's spinning, a lot of numbers to go through and their first time ever looking at a captive, what would you tell somebody? I tell people all the time, you got to go through these presentations a couple times. It takes a lot to learn. So I don't want to discourage anyone if they are, feeling overwhelmed by this. But what would you say is a great process for someone who is interested in a captive to continue to educate themselves and to gain more understanding? What would you suggest or for someone to do that's interested?
Well, that's why I flipped to the next slide, because it's the first thing. We'll do the math.
Oh, I love that.
You It's a free actuarial study. At the end of the day, so by us looking at your current and 5 prior years of premium losses and exposure, it's just free information. That information can be used for a couple different ways. One, because you're interested in joining the captive. Two, use it to beat up the current insurer and say, hey, look, this is how I've actually performed. So you guys are making a lot of profit off of me. So we'll do that modeling. We do, 20, 30 models a day. We have a whole team that does it. So it's real easy for us to do that math and let us know, are you making money for the insurance company or costing them money? If you're making them money, then you should join a captive because it's a good way to control that. The standard market, again, as I mentioned earlier, their job is to return a profit to their shareholders. The problem is their shareholders are on Wall Street, whereas the captive, our job's to operate in the best interest of our shareholders as well. The difference is you guys become the shareholders. But yeah, certainly it's easy. We just do the math. It's a pass-fail approach. We model it and say, yeah, this looks good, and here's what the numbers look like. And if it doesn't look good, we don't just say, sorry, you're not a fit. We'll tell you exactly why we don't think it's a fit and what improvements or what history will do once the years change. So yeah, I think one, we'll do the math for you. Then it comes down to, do you have that desire for stability and control over your pricing? The willingness to be involved, that's attend the annual shareholder meeting, which we understand not every year you can make it, things come up, but mandatory is the safety meeting. So send somebody to the safety meeting. And then we say take safety up a notch, but that happens automatically because you go from being a renter of your insurance to an owner. So that's really what we look for in PowerTech members. And again, it's an easy process for us to evaluate and see if it's a fit.
Hey, Tom, can you hear me?
Yep,
Hey,
absolutely.
it's John Roark. We've had other captives before where they'll invite the members to attend the board meeting or the safety services so they can kind of meet some other members, do those sort of things. Is that an option at all? I know when you start going through the actual financial performance, hey, that's going to be closed door, but we've had some guys that, it's kind of difficult to get these guys on board and they want to feel more comfortable meeting some other guys. Is there any options of that?
We don't have other, because again, it's like if you asked GE, if you called up GE and said, hey, I'm thinking about buying a share of stock in your company, can I come sit in on your board of directors meeting? They'd say no. So we don't use I know there's some captives out there that use their captive meetings as a sales pitch. That's
Yes.
certainly not what we do because these are true member-owned group captives. We're absolutely happy to introduce you. We share a member list if you're interested in joining once we get through all. Because by the time that we get to that point, John, we've gone through the math. We think it makes sense. We've presented to the insured. They like the concept. Great West Loss Controls approved it. Great West Reinsurance has approved it. Our new business committee is all on board. So at that point in time, what we do is we'll share the member list. Absolutely, we'll arrange any conversations you want to have with them. I guarantee you'll know some of the people in there. Pick up the phone, give them a call. We're absolutely happy to do that. We don't invite prospects to attend the board meetings or the safety meetings because that should be for that closed group to focus on what they want to focus on. But certainly we'll make it available. And like I said, I guarantee you'll know a lot of the members in there because they're all best in class companies from across the country.
One last thing, is there a way we can get a recording? I know this is being recorded. Can we get a copy of this?
Yeah, the slides,
John,
absolutely.
Yeah, and John, I've got the meeting recorded, so we can send it out to anybody. So
Yeah, I think this would be great. We've got one right now that's exactly, you guys have already approved it and everything. He's just kind of on the fence and looking at this, you're doing a great job selling this.
Well,
one thing too, to kind of open up to all of our guests here, do any of you got questions? Well, Tom's available. I know we're kind of 6 minutes in till kind of we have this scheduled out. Does anybody want to unmute themselves and have any questions that have come up? It's okay if not, but I thought I'd open it up for that.
Hey, Raymond, I'll send a couple out there real quick. Tom, the risk pool, does that have any dividend potential?
Absolutely. It's zeroed out each year. So I didn't want to overcomplicate, but essentially what we do is we fund it to 100% of our ultimate expected losses each year. And then at the end of the year, we zero it out. But your profit from it isn't based, maybe unfortunately you had that $1 million claim that year your profit isn't imputed by that. It's based on how much premium you contributed to that layer compared to the other members. That's your percentage of ownership.
Fair, fair. And then as far as ARU goes, on the aggregate from the captives that you manage, not just this one, because this one's not quite as long of a history as some of the others. What have you found to be the retention rate of ARU captive members? So once they get in, what is the stickiness, and what is the I would say, how happy are they with what the decision they've made to go into an ARU captive?
It's not 98% over 24 years. And I could tell you on PTE, we had one member leave because they sold their trucking operation. And then we had two that we had to ask to leave, and it had nothing to do with their performance. One, it was because they could never seem to pay their premium on time, which just gets frustrating after a while. And one is the guy was verbally abusive to our staff in Cayman Islands. So that's just not the type we kind of have the no jerk rule. So, Mike, you could have the best client in the world, but if you were a jerk, we couldn't write them. And the same thing, you could be the nicest guy in the world and your client's a jerk, we can't write them because this is a private club. And the members, I can tell you for our board meeting coming up here in March for PTE, I would say we probably have about 85% of the members are attending, which is huge. Like normally you get about 65, 70%. We have over 220 people at that board meeting. So it's well attended. People bring their wives, their families. Again, we invite our agent partners. We think it's important to attend. And the fact that so many show up because they end up meeting new people that you guys are all in the same industry, but it creates a whole new peer network for you as well, and people that you can trade business with.
Yeah. And for the folks that are listening, and John, correct me where I go wrong, but as far as typical retention rates on insurance programs, I mean, you're looking at maybe 80, 85%. So having a 98% retention means that the folks that are getting into these, that this thing is performing as described and as intended.
And Mike, that does bring up a really good point. Sorry, John. I was just going to say, by the way, it's real easy to leave the captive. All you do is go buy insurance somewhere else. You go into what's called redemption. There's a 2-year waiting period before we can even review you for redemption. But let's say you're in for a short period, you ended up selling your company. At that 2-year mark, we start reviewing you every board meeting. So the goal is to redeem you as soon as possible because of our unique structure, where again, only the first 200,000 of any occurrence impacts your equity. We're able to redeem our members a lot quicker than any other captive, because in those other captives, they have that A fund, B fund, and everybody thinks if they have a claim that's out of their A fund, it's going to come back into their B fund. So they don't want to close out those policy years. So they can't close out policy years, which means you can't be redeemed. With us, if we have a claim that's 3 years old, then certainly I would expect that we've spent $200,000 on it, because otherwise, why haven't we closed out that claim?
Yeah, I always explain it to people of you're paying for what you need and nothing more. There is no profits going to Warren Buffett at the end of this thing. It is all the money that is not used is coming back to the members. So
plus the investment income.
Plus the investment income. I mean, the reason the retention rate is so high, that 85%, that is more of a goal for the insurance companies, and very rarely do they hit it. I'd say 78 to 82 is probably average in the traditional insurance marketplace. I mean, the numbers don't lie. If it's 98%, people are joining into this and then they're not going back. And then the other way to look at this is if you're a pond and there's fish in the pond and those are all clients and, people in the traditional pool, the best fish are all leaving that pond and starting their own pond of like-minded individuals in these captives. So what's left in the original pond,
Right. Exactly. Well, and that's all the best in class. The standard market, they're pricing it based on how the industry performed. That's how how many times have you had an underwriter come in and say, well, we didn't do well this year, so everybody's 10% is our minimum increase. Well, why is that your problem that they were a bad underwriter that year and that their book didn't perform well, so rates are going up? Same thing with the industry. If the industry is not performing well, you're suffering because of that. Because of this, our unique structure. So we're looking at your 6 years of loss history to develop your premiums. That reinsurance, we're only buying up here. That's the only part that's subjective to market volatility. And I can tell you over the last 5 years, our reinsurance has been flat, so we haven't seen any increase on that. But even if our reinsurance went up by 10%, that would only impact each member by 1.5% because the bulk of the premiums in the captive layer. So it really stabilizes that pricing volatility and takes you out of the rat race that the standard market is. You're based on your performance. And again, like I mentioned, how easy it is to leave, but members don't leave because it's firing yourself. And just in summary here, again, we think it's important that we're independent, privately owned, not owned by a brokerage, not owned by private equity. So we could really focus on the underwriting acumen and making sure best-in-class companies get in. That unique structure, how the losses always go vertical. The smoothing effect, how we look at you cumulatively for all years. Everybody's going to have a bad year, but the fact that we're looking at you cumulatively really helps protect you because it's going to offset that bad year. No other captive does that. The customizable approach, if you're 48 units now and in 3 years or in 10 years you grow to 150, we could utilize different deductible structures. Not a lot of captives will utilize different deductible structures, but again, we have from 10,000 up to 200,000, which gives us the ability, and because of our unique risk-sharing structure, gives us the ability to be able to write fleets ranging from 20 power units up to, I think right now our largest is probably about 1,200, and it doesn't adversely impact that shared layer because again, that's outside your equity. The unbundled approach with all of the service providers, I can't speak enough to those tax dividends that start in year one. If you've ever looked at any other captive, they probably didn't even talk about it, but it's called a 5471 form. You get that each year. It's like a 1099. You have to pay tax on that. With us, you know exactly what's going on. Plus, we're sending you a 40% tax dividend, regardless of if you had taxable income that year. Because I know a lot of maybe your depreciation gets adjusted by whatever we're allocating to you. We're still going to pay you a 40% tax dividend. And then the underwriting dividends that start 4 years after expiration, now that's previously taxed income. So you're not paying tax on those. And then again, the agent broker driven approach, we think Roark Sutton's an important part of your insurance success. So we want them to be knowledgeable and understand the captive and be involved as well to continue to be an advocate for you. So that's really just kind of in summary there. And then, as I mentioned, I'm sure if any of you have questions, please feel free to reach out and we're happy to answer those.
Thank you, Tom.
Yeah, Tom, thank you so much. And thank you everyone that's joined in. Look forward to visiting with you about it.
Thank you guys. Have a great day.
Thank you.
See you soon.
Bye-bye.